Welcome back, everybody, to another episode of Capital Clarity. I'm going to start these very cheesy now, just to break the ice here. But yeah,
Do a
we're
little
back.
Good Morning Vietnam intro.
Yeah, Good Morning Vietnam-ish. But yeah, we're back. We had a great trip down to Scottsdale, Arizona to see some clients and also see the Barrett-Jackson auto auction, which was a phenomenal time. I should be thanking you for letting me tag along. That's usually your trip. So thank you.
Yeah, that was a great trip. I loved it. Here, I got a little. So this.
I got a picture from it too.
This was the number one highest priced car that sold at auction at Barrett this year in Scottsdale. One of one 2026 Chevrolet Corvette. And it was you can see on the right that little emblem. It was a charity deal, so those usually go for a lot more money.
Yeah.
So kind of cool.
We saw a truck get auctioned for a charity, and I think it was 3 times in a row the bidder just donated it back to the auction. So
Yeah.
It kept getting resold, and I think they ended up raising about $860,000 for the charity, which
for a
was
pickup truck.
Which was so cool to see for a pickup truck, which was so cool to see. It was a cool looking pickup truck, but still.
Yeah. Well, this Corvette sold for $2.6 million and change.
Wow.
So definitely, I wasn't bidding on that one or any of them.
While we were down there, I was going to say we saw something else interesting, actually not at the car show, but still car related while we were down there. I think I talked on our last podcast, which has been a little while, but I talked about how Waymo is getting commercial use now, no longer tested. Like it's in use in cities, in warmer cities in the South and in the Southwest, Phoenix being one of them, which, Phoenix, Scottsdale, we were in that general area. And we talked about that a week before we left on the podcast. And I get there when we get to the hotel. And what do I see when we get to the hotel? I see, for those of you watching, I see this guy. A driverless Waymo car. This was taken
that's
by
actually
me.
the picture from the hotel.
This was taken by me directly outside of our hotel in Scottsdale, Arizona, and makes sense because it's one of the cities we just talked about that is actively using them for commercial use. I'm going to zoom in a little here, but you can see it's fascinating. It's got a camera on the back, and these things rotate. This thing here, the cylinder rotates, and it's got cameras on the side, and then one big, satellite-looking thing on top. I don't begin to understand the engineering behind this, but it was pretty cool to see this thing drive by you with all these spinning parts on it. And you're like, what is that? It says Waymo on the side. It says Waymo on the side, and you look inside, and there's no one driving, but there's someone in the back seat.
It was amazingly good at driving too.
I was
surprised. It was funny as I'm thinking our clients in San Francisco are going to go, yeah, you country hick rubes. That's a Waymo. They're everywhere, but they're not for where we are.
I was so fascinated. I watched the Waymo car go into the parking lot that it was going into to see how it would fare with stop signs, other cars coming in, because it was a busy hotel parking lot, nice weather and everything. And it stopped for other cars in the correct way, not in a confusing way, drove the exact speed limit, stopped at stop signs for a full stop. It looked completely safe. Which is amazing.
Impressive. Yeah. I got one more from our Barrett trip. This is, sorry guys. This is the car that I was really trying to not buy, but really wondering about. And here you go. This is the 1966 Lincoln convertible. This thing ended up selling, not charity either, $1.1 million. Amazing.
That's insane. And you were big on that car. I don't like it. I'm going to be honest.
Well, and I get it. I'm an older guy, but it's such a classic. Plus, it's really unique. But so I ended up, I don't know if I told you this, I ended up finding out that the guy who sold this at the Barrett auction for $1.1 million, he bought it 3 to 4 months ago in New Jersey for $80,000.
Oh my gosh.
Basically out of someone's garage. It was banged up. He rehabbed the body, the door panels. He did brand new interior with that camel color interior and put a brand new engine in a big, giant 8-cylinder, really big engine. And ended up, I don't know what that cost him, but it definitely didn't cost him, $900,000. But he ended up buying it for $80,000, rehabbing it, and selling it for $1.1 million 4 months later. Amazing,
that is
huh?
an amazing turnaround. Oh
Yeah.
my gosh. Yeah, it just looks like a boat to me. It looks like you could toss it in the water and it would float.
Yeah, it's gigantic. I mean, where do you even park that? So,
Yeah.
but it's kind of neat.
All right, let's get down to business here. I'm going to go first. So, been hearing a lot lately about, you got to get out of US stocks, you got to get into international. And I get it, international stocks, especially European stocks, have been uh, so much underperforming US stocks over the last decade or so that they're now priced very inexpensively and it makes sense to buy them. I get that. But saying that everyone is getting out of US stocks is just, in my mind, not true. I mean, look at this chart from Barron's. Europeans are big buyers of US stocks. If you're listening, this chart basically shows investors from Europe owning about half of all foreign US stock holdings. Investors from Europe own about half of all foreign holdings of US stocks. Pardon me. So it's showing Denmark, Finland, France, Germany, Netherlands, Norway, Sweden, and the UK, as well as the rest of Europe owning a huge chunk of US stocks. That number just keeps going up throughout 2024 and 2025 and even now in 2026.
Yeah, it's funny. The news stories keep saying, well, the dollar's been going down, which it always goes up and down. It's decade after decade how it moves. And that means foreign holders are selling their U.S. assets, real estate, stocks, bonds, whatever it is, and repatriating that money to their countries. And this shows the exact opposite. I mean, we're big on data, and this is just data. It doesn't just show that they're flatlining; they're increasing their holdings of U.S. Security stocks. So, yeah, interesting chart. That's a great chart.
And then parlaying off of that, I found this little blurb from Mia's Take or Maya's Take. I'm not quite sure how to pronounce that, but here you go. I'll share it right now, and I'll read it off for those of you listening. We've been hearing all about the Sell America trade for months, and so far the opposite has happened. Foreign holdings of U.S. Treasuries hit record highs in November of 2025. The only country that has continued to actually sell American debt is China, and they started doing that way back in 2017. Macron has been praised for referring to Trump as a bully, and Mark Carney said that the world is in the midst of a rupture, not a transition, but you wouldn't know from their country's actions. Over the past year, Canada and France have increased their holdings of U.S. Treasuries by $100 billion and $44 billion, respectively. It's also not realistic that Europe will dump its holdings of U.S. assets. Most stocks and bonds are held by private pension funds, insurers, and asset managers in Europe, not governments, meaning they can't just be ordered to sell.
Right. Yeah.
Yeah. All to say, U.S. assets aren't going anywhere.
Yeah, and your first slide was on stocks. This one's on bonds, treasury bonds. So, yeah, I mean, capital ebbs and flows around the world. We've got a global economy, but the narratives would tell you one thing and the data tells you the other. Good point. Nice. So maybe this is one of the reasons. So if we look at earnings for U.S. stocks using the S&P 500 as the proxy for U.S. stocks, and this chart from Ritholtz is really fascinating. It basically says, okay, stocks were up in 2025. The S&P 500 was up about 17, 18% or so for last year. What created that? Was it dividends? Well, dividends only contributed 1.5% of the 17.9% gain. Nice. Dividends are good. Multiple expansion. That would be people saying, I know the earnings aren't going up they're going up X amount, but I'm going to pay X plus more amount for these stocks. That's multiple expansion. When we get a lot of multiple expansion, that's what happened in the late 1990s with a lot of tech stocks. People started paying, $10 for what should be a $2 stock. We're not really, last year, 2025, we only had a tiny 2.1% of the gain created by multiple expansion, and that's actually very healthy. Where did the bulk of last year's gain come from the S&P 500? Earnings growth, 14.3%. That is a knock the cover off the ball kind of number, 14.3% in earnings growth. So the underlying engine that tends to drive stock prices in a healthy manner over time, that being earnings growth, was very, very strong last year. And just a follow-up to that real quick. This is a longer-term snapshot of that earnings being a driver over time of stock prices. another Ritholtz chart, and this one goes back to the year 2000. So we got 25 years of history, and there's a red line that shows the price of the S&P 500, the movement in the index of 500 stocks, and there's a blue line showing the reported or trailing or historical, the actual reported earnings by the companies, the 500 companies in that index. And they're not perfectly correlated, but they're heavily correlated. They really move similarly. Earnings down, stocks down, earnings up, stocks up. So it kind of gives you a feel. Earnings are a really important thing. And right now, we're, at this point at least, really fortunate to have a pretty strong earnings picture.
Yeah, I mean, they're not moving in lockstep, but the trend is the same. And I think especially in today's world with so much information flowing so fast, and we all have supercomputers in our pockets. It's easy to think, well, you know, politics, I don't know, the economy, all this influences stock prices. The biggest thing is, are companies making earnings? Are they making money? Yes.
Exactly.
Stock prices are probably going to go up.
Yeah. It's the biggest driver. I mean, it's why, again, it's data driven, which is wonderful. But it's all about earnings. So all about the bottom line. And I think, people easily forget. People think, some people start to think stocks are like gambling. It's like, we'll take a shot, see if we make money. Well, at the basis of it, when you buy a stock, you're truly an owner in that company. You own a tiny, tiny little sliver of that company.
Yep.
And so don't forget that. You're not putting money into some digital thing that may or may not go up and has no real underlying basis to it. You're harnessing the efforts of the humans that go to work every day at that company and try to push the ball forward for the company and also, of course, for their own families and their own lives. So that's a really powerful thing. I mean, we easily forget in this digital age of websites and trading apps and all these crazy things that it's all about owning pieces of companies that are trying to be better and more efficient every single day.
Yeah. You're investing, when you invest money in a stock, you're investing in, so many people, hundreds of thousands of people, going to work every day to better their lives and therefore better the company. I think that gets lost. I want to switch over to real estate real fast. So interesting pieces that I didn't know. So this chart, if you're listening, is from Case-Shiller. It's the S&P totality Case-Shiller home prices versus other assets. So what this is showing is, over a 20-year period, it's showing the annualized returns. So the average return each year over the last 20 years for different asset classes. One being gold, and then the U.S. stock market, and then a whole bunch of different home price markets, residential home
for
price,
different regions.
Home
this
price
is a great
markets
chart.
for different regions. For example, Las Vegas, D.C., Chicago, Minneapolis, New York, Cleveland, San Francisco, Tampa, Los Angeles, Miami. You get the point. It's basically showing local home prices and national home prices in different metropolises throughout the U.S. Severely, in terms of annualized returns over the last 20 years, severely lagging that of the S&P 500. So just for example, the highest annualized return over the last 20 years for all of these listed housing markets is Dallas. It's the three-way tie between Seattle, Dallas, and Charlotte, each at 4.4% a year annualized growth over the last 20 years. The S&P 500.
So you bought a home in Dallas. Generally, you saw your home go up in value 4.4% a year over the last 20 years.
Yep, since 2006. And the S&P 500, 10.8%. So you put money in the S&P 500, the American stock market, back in 2006, as opposed to a 4.4 annualized return, you saw a 10.8% annualized return. I show this just to say, with such a boom in home prices over the last, really since COVID, I guess, I've been getting a lot of questions about, why don't I own more real estate? Why don't I own more real estate related investment vehicles? They seem to be doing amazing in recent history. Yes, in recent history, but when you stretch out time, even just over 20 years, which isn't that much time in the investing world, it's shown that, stocks have just historically done better. And then also just piggybacking.
That's a great chart, dude. The thing with that chart is that something, if I offer just a little color. So
Yeah.
real estate, we don't dislike real estate. It's
No,
wonderful.
gosh, no.
You can buy it with incredible leverage, put 5% down, control the whole house, and that amplifies returns over time. You can, depending on how you work your real estate, if you have a bunch of rental properties, you might get extraordinary tax benefits, or maybe a business property for your business. Then there's other downsides to it. People, there's a lot of maintenance hassle and so on. Everybody knows about those things. But I think what people get carried away with is, like, I'll give you an example. 4.4%. You grow money in anything at 4.4% a year, like Dallas homes did in the last 20 years. It pretty much almost doubles in value in about 15 years, a little more than 15 years. So what'll happen is, I think somebody buys a house, 15 years of their life go by in that house, and they go, wow, I paid $500,000 for that house and now it's worth $1 million. That's incredible. Yeah, it's about a 4.4% per year return, but they can't believe it's only that much. It's just 15 years of compounding,
Yeah.
And when they hear 4.4, they go, oh, that doesn't feel as good. That's just how they move.
You're absolutely
it's a different
right.
asset. It's a wonderful asset, just different.
Piggybacking off that, this is from Bespoke Investment Group. I didn't realize that this is an interesting stat. As shown below, most cities tracked have seen annualized home price gains of less than 3% over the last 20 years. That's worse than the 3.1 annualized return for the long-term Treasury ETF. So basically government bonds, long-term government bonds. So you essentially, in most major metros in the US, you would have done better buying long-term government bonds in terms of your return than you would buying residential real estate in the market you're in.
Yeah, that's well said. Now, if you buy a treasury bond, okay, I can't really buy it, if at all, with leverage, so I can't amplify my returns like I can with real estate with a mortgage.
Or take advantage of tax benefits.
I can't do that either. But my treasury bond doesn't call me and say the toilet's broken, the AC's out, something broke. What about the real estate tax bill that's due? You know what I'm saying? It's a more simple approach. It's just different. Nothing's perfect, each his own. But yeah, it's quite enlightening when you say, well, I could have just bought a treasury bond and got the same average annual return.
I feel like by bringing this up, people are going to think I'm trashing owning real estate. I'm not by any means. I'm just pointing out interesting stats that personally I didn't know existed until this week. And then also just saying, there's pros and cons to both. Owning real estate, like you said, gives you leverage. It gives you amazing tax leverage as well, tax benefits. But it also has a lot of downsides as well to it. Just like
we have clients
who've got pros and cons.
Yeah, we've had clients who's crushed it in real estate. But the one thing, we've said this before, those clients do is they run it like a business. You know, I own 10 rental properties, got everything set up in QuickBooks. I run this like a business. This is not a little hobby. Let's see how this works out. They run it like a business.
Yeah.
Yep. Good stuff, man. Yeah, those are great charts. Great charts. Here, I got one while we're on real estate. So Charlie Bellello put out this piece on interest rates. No, I don't want to. Hold on a second. I'm sharing the wrong one. Sorry, everybody. I shouldn't be allowed to take the wheel. There we go. There's the right, so you can see it more clearly. So Charlie Bellello said 30 million U.S. households, which are more than half of the primary mortgage holders, have mortgage rates below 4%. So basically, more than half the people who have a mortgage in the United States, they have a mortgage with an interest rate that's below 4% a year. And right now, what's it at, Keith? Like 6.25?
Isn't it 6.25?
It's probably right around there.
I think
it reached as high as 7%.
The 30-year?
Yeah. That's what I mean, 30-year fixed. And so, these people are at 4 when today it's at 6.25. And so Charlie says this is still the number one factor driving the limited housing supply, as many of these homeowners can't afford to move. Because think about it. I'd love to move, but I'd have to sell my house and get a new mortgage on my new house, and then I go from a 4% mortgage to a 6.25% mortgage. The math really changes when that changes. It's a big shift. So
I think
frozen real estate market.
Yeah, a lot of people just, like you said, frozen. They don't want to pay the higher interest rate. Um,
I wouldn't want to.
no,
Who wants
why,
to do
why,
that?
why would you? Yeah, unless
Yeah,
you're not using a mortgage and just doing a full cash offer. I mean, yeah,
yeah, yeah,
yeah.
yeah.
Wonder if that could also lead to some of the reasoning behind this from Chart R. Record number of Americans are living alone. And if you're listening, this chart has gone up, it looks like almost each year over time since the year 1960. For example, um, back in the year 1960, about only 5% of households were considered one person households, meaning that there's only one person, they live alone. There's no one else that lives with them. That number went from around 5% back in 1960 to over 25% today in the year 2026, um, which is astoundingly high. So over a quarter of households are just is just one person. I wonder if this part of this has to do with, you know, people not moving homes, like you said. They don't want to pay the higher interest rate, and that leads to younger people, first-time home buyers, not moving, just continuing to live in apartments and not willing to or not able to find a new home because there's restriction. There's a very limited supply right now in homes for sale, and then also they don't want to pay that high of a mortgage rate either once they move,
Or they can't.
where they
Yeah,
physically can't. Yeah,
yeah. I don't know. We pull this kind of stuff up all the time, and it's real. It just makes me sad. You know, I mean, hey, not that there's anything wrong with living alone. I'm not saying it's just more that I don't know how many of these people are really choosing this. I think it's more forced upon them. You know,
yeah,
it could be. It's so tough. The single biggest, in my opinion, financial hurdle, other than securing a good job and keeping a good job right now, is basically for your generation, Keith, is and I'm stating the obvious, is home prices, buying a home and forming a family. We'd love to get married. We'd love to have kids. And you don't have to have a home to do those things, of course, but most people will hope to not be in an apartment or at their parents' home to do those things.
tougher to do it without a home.
Yeah,
Yeah,
much tougher.
yeah, I agree.
That's a good one. I didn't see that one. Yeah, I don't have any more. I just got a little story, but
Can I have you tell the story last?
yeah, go for it.
I have one more that I think is pretty interesting. I'm just pulling it up right now.
I threw you a curveball going straight back to you.
So just going back to the stock market real quick. I know I jumped around from stock market to real estate, now back to stock market. But I think I saw this week from Bloomberg and FactSet, and I think this is pretty interesting. So we're hearing a lot about right now comparing this quote unquote AI, artificial intelligence era to the dot com era back in the late 90s, early 2000s, back when we had all those internet stocks running up and making great returns at the end of the 90s and eventually till it stopped and stopped very abruptly in the early 2000s. We're hearing about how, gosh, these especially the Mag Seven, the Magnificent Seven, these stocks today are running up so much and they're returning so much. It's just like the dot com era, and eventually it has to break like the dot com era did. And I'm not saying that's not true, but okay, let's compare. Let's look at this chart and compare the total returns for the S&P 500 tech sector during the dot com era in 1999 to 2000 to that of the AI era from 2024 so far through 2025. So in the dot-com era, the S&P 500 tech sector had a total return of 94%. So far in the AI era, which is this chart is saying from December 2024 to December 2025, it's a 24% return. So I guess what this chart is saying is there still could be room to run.
Yeah, it's interesting. I look at this chart and I go, all right, well, one period of times for
It is
well,
only taking a year or two from each era,
yeah, it's
but
just a couple of years. But I think the point being made is valid, is that yes, we could easily get to a late 90s, early 2000s scenario where people go crazy buying the Mag 7 or the AI stocks, which are kind of one and the same in a lot of cases, and push their valuations to stupid levels. And people like you and I are saying, this is dangerous, and then they go higher again, and eventually it ends, and it ends badly. It just, from this chart as well as a few others I looked at, and we just sent out a market mail called "Is This a Bubble?" And in there's a graphic that speaks to this as well and shows from a valuation standpoint that these technology stocks of today, in general, not all of them, but they just haven't put in that kind of run. They haven't detached from reality of their earnings. The earnings are supporting their price appreciation in their stock, and so could we get there in 3, 5, 10 years? Sure. Humans always do dumb stuff. That could happen, but are we there now? It doesn't seem likely.
Yeah. Good point. All right, I'll shut up. That's all I had.
All right, so I was talking to a friend that's an old high school friend that we weren't even that close, but he gave me a call and we caught up. And turns out it's amazing. I used to valet cars and be a bellman at the Ritz-Carlton in Boston when I was in college. He's the manager of the Ritz-Carlton in Boston now.
No way.
And so we were laughing about that and talking. And I said, "Hey, do you guys still have, valets and doormen and, the bellmen and all that?" And he said, "Oh, yeah. I mean, it's a 5-star hotel. We're never getting rid of those." And he said, "Actually, let me tell you a story." He said, "We've got a real hard-charging, younger junior manager at the hotel who's really great. He tries to innovate and give us great new ideas, but sometimes he doesn't know that he's not mature enough to know certain things." So he said, he ran the math on the doorman, that our primary doorman who's there. We have multiple ones, but the one who's there during the most important weddings, events, days of the week, and he basically ran it through AI, and he came back to us and said, "Listen, the doorman costs you $40,000 a year. That's what they pay him, and then of course he makes way more in tips. That's really where the business is done for the doorman." He said we should consider replacing the main doorman and all the others with an automatic door opener, because why do you need somebody to open the door when you could get a machine to do it? And we can save the hotel a whole bunch in costs depending on how many doormen we replace. And this person who I was talking to the phone, he said he told him politely, "No, thank you, we're going to keep the doorman." And the guy asked why, and he said, "Well, listen, because what happens if we do this and we replace the doorman with a robot or a door opener?" He said, "This hotel's going to be a mess. The doorman does way more than open the door. Right now he makes sure that people aren't sleeping in the doorway. He hails taxis. He deals with luggage. He recognizes our recurring regular celebrity guests. There's all kinds of status that comes from having that person there. Lots of value creation that you can't really quantify in terms of door open and door close." I thought that was really fascinating, right? Because as much as you can efficiency expert and McKinsey everything and use AI to find the exact right answer for efficiency, at the same time, sometimes the real world says, you know what, that's not exactly a good solution in this situation.
Especially at a place like the Ritz, where they really thrive on that personal touch of great client service. I mean,
yeah.
If you need to learn about client service, the Ritz's handbook is, the best place to start.
Yeah, they are. They know what they're doing. At the time when they put me through training in college, all I was thinking was, I need to make some tip money so I can go buy more beer and hang out with my friends. That's why I'm here. Why are you putting me through 3 weeks of training? Let me go park some cars and earn some tips. And I look back shortly thereafter, maybe 3, 4 years later, as I got more mature, and I realized, wow, they taught me some of the most important life lessons. So one of the big things they said, listen, we're human. This hotel's going to have errors. We're going to screw something up. Somebody's theater tickets are going to be for the wrong seats, the wrong night. And so when we do that, we make it right. We get the right theater tickets, and then we get them free dinner somewhere at a 5-star restaurant. Or we make it right, then we make it right again. And there was just one little lesson, of which there were probably 20 or 30. And I remember thinking, gosh, that's so smart. They turn defeat into victory times 2, which is really brilliant.
Yeah.
Ritz knows what they're doing.
They really do. They really do. All right. Well, Super Bowl this week. Any predictions? Or do you not want to be wrong the next time we record?
No, I don't mind saying I think Seattle's going to win.
I mean, they're favored by, I think, 5.5 was the last.
Are they? I didn't
time
even
I saw
know.
the line. I feel
Yeah, I should have
weird
assumed
not
that.
saying Seattle just because they are favored by so much, but watch me be, completely incorrect. So
You know,
we'll see.
it might be my lack of familiarity with the Broncos, but Seattle just seems to be a team that's gelled. You know, they just
You
seem
mean
to
the
be
Patriots?
all Patriots. Excuse me, I said Broncos. I'm sorry, Patriots. Seattle seems to be a team that's just completely gelled. They just seem to, I don't know, they just have that vibe where they're all for one for all kind of thing. You know?
Yeah, I don't think it's a morale thing with the Patriots. I just think the talent is slightly better over in
Yeah.
Seattle, but
If
we'll
you're a
see.
Patriots fan, hey, maybe they win. The thing is, if they don't win, don't worry. You got a lot of years ahead of you. Good stuff. They got a relatively young team. They
Yeah,
got a great young quarterback.
they
They
got
got
a
an
lot of money to
incredible
spend too.
coach.
They're not. If you look at their contracts, they have some of the most, I guess, cap room you could say in the NFL.
Yeah.
Yeah.
Yeah, the thing is, you don't need me to console you if you're a Patriots fan. You've
No,
won, what, 25 championships across
you're
all
good.
four sports in the
Yeah.
last 25 years? You,
Yeah.
you guys have been on fire. How about
You
letting some of
guys,
us get some of that?
you guys had what, 6 Super Bowls and then went into a rut for a few years, all while the Bills didn't even make it back to 1 Super Bowl, and now you're back.
Yeah. Yeah. Feel bad for that. Yeah,
Yeah.
right. I know.
Yeah.
I know. It'll
All
be a
right,
fun
guys.
game.
Yeah. All right, guys. Well, thank you as always for listening. Please remember to keep giving us listener questions. We appreciate them. Thank you.
All right.
Oh. The Capital Clarity podcast is presented by FA's Keith Wagner, AAMS Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 Southeastern Road, Suite 100, Doylestown, Pennsylvania 18901. 267-742-3455. Raymond James and Associates Inc., member New York Stock Exchange, SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.